Hi everyone, my name's Darryl Panes, CEO at As Good As Gold Australia, and today once again I'm joined by my brother Brian and partner at As Good As Gold. And today we interview John Adams, Chief Economist at As Good As Gold Australia. Good afternoon, John.
Good afternoon, Darryl and Brian. How are you going?
Very well, John. It's been, once again, it's been a long time between drinks. As my father would say, a lot of water has flown under the bridge since we spoke last in an interview. But a lot's been happening, and so we've got a lot to catch up on. And I listed 9 points just very briefly, and I don't even know if we'll get a chance to speak on all of these today, but it's 9 of 9,000 points that I think I could have raised. But if I can start with one, just very, very quickly, and I'll just run through the 9 points. Governments panicking, as I believe they are, and continuing to cut interest rates. We know where we're heading there. In fact, we can't go much lower. We're looking with another 2 rate cuts, we're down 0.5%. There isn't far to go from there, so they're starting to run out of bullets. Point 2, trade wars, US and China. Increased tensions there. No one wins in trade wars, least alone Australia. Point 3, cargo ships being torpedoed, raising the possibility of war. Point 4, cargo ships carrying Australian coal being turned away from Chinese ports. That's not a good sign at all. Australians strengthening diplomatic relationships with the US. Even though that seems to be sound, this is at the risk, I think, of straining our relationships with China. Not good when our reliance upon China, so far as trade is concerned, has been so strong in the past, and we need it to be strong today. Point 6, global and Australian government and private and household debt continuing to run rampant. Point 7, the US yield curve inversion between the 3-month Treasury bill and the 10-year note widened at its deepest level since the GFC. Historically, this has been a very strong indicator, and we all know this, of course, as to an oncoming recession. Point 8, the Australian real estate market continues to fall into disarray. And 9, surprise, surprise, gold has recorded its highest price in Australian dollars in our currency in recorded history, as one would expect. For those who are a little educated in this area, would fully understand, of course, why that's happened. So we've got a lot to cover, John. So maybe I should start with point 1. I think governments are panicking, and I'm obviously interested in your comments here. Continuing to cut interest rates. As I mentioned before, we don't have far to fall before we get to zero. And as I said, out of bullets, I don't know where you go from there. But I want to highlight this to start with. This is a report out of the Advertiser going back about a year ago. And it says, the rise and rise of real estate and the best is yet to come. I mean, how far wrong can you be? This is mainstream media, John. This is our main newspaper here in Adelaide. That was 12 months ago. So since then, we've had so let's discuss the property market. We've had a Royal Commission since then that led to a complete overhaul of the bank's lending criteria. So that means it's harder to get a loan. There are less buyers in the marketplace. Properties fall in value as a consequence. Now, since then, the government and APRA have done a full circle, relaxing lending criteria and increasing demand, of course. So it appears to me that they're between a rock and a hard place. I don't know where they would go from here. So if they stiffen things up, the market just stalls. And so they've got to change their policies again and make lending easier and create more debt and more incentive for us to increase our debt to get involved in the housing market. A gentleman by the name of Dr. Richard Hames predicted the 9/11 and GFC and said the real estate market is about to fall off a cliff. How do you think, John, the new stimulus package with the 5% deposit for new home buyers and reducing interest rates further will play out? What are your thoughts?
Look, a very interesting question. It's interesting you put up the article from the Advertiser. Yesterday there was a story report in the Australian Financial Review. BIS, Oxford Economics, has come out and said that in the next 3 years they expect property prices in Brisbane to increase by 20%. So the reality is that the spruikers haven't stopped. The spruikers continue to pump the market up. And that hasn't changed.
I keep getting back to this, John. I keep getting back to this. The spruikers never stop. I agree with you 100%. Continue. Sorry.
Yeah. So obviously when you look at the equity markets, there was a lot of concern, particularly in the US in December last year. Trump put enormous pressure on the US Federal Reserve to stop tightening policy. And then obviously you had Jerome Powell, the chairman of the US Federal Reserve, change tact in terms of what policy would do in 2019. And then you saw the share market really roar up in late December and throughout 2019. And we've seen, say, the S&P, hit an all-time high, and the Dow, etc. So we've seen a reversal in policy. In the Australian context, there was a lot of negative sentiment before the federal election. Because of the opinion polls, there was a lot of expectations that Labor would win, and that Labor's policies would lead to a aggressive acceleration acceleration and the downward spiral of house prices. And the reality is that in terms of the federal government, the federal government, many people in the federal government did not expect to win. I had a federal MP on the phone with me in January saying that that the election was going to be the worst defeat for the Liberal Party since Menzies established the party in the 1940s. So there was an expectation that they were going to lose. And of those in the federal government who know what's going on with the debt bubble, they effectively thought that they were going to hand it over to the ALP. And they're going to hand it over to the ALP to manage it, so be it in terms of what Labor would do in terms of the bubble. Now the sort of bit of a shock is that the coalition, surprisingly won the election, and so now they're holding the baby. And before the election, there were several signs that I was tracking. And one of the things I was doing was looking at the early warning signs that were evident in Ireland of a housing market crash, and looking for those signs in Australia. And there was a number of indicators in the first 3 months of 2019 in terms of the calendar year that would indicate that the debt bubble and the property market were really going to fall into a systemic collapse. And then since the election, so there are a few things. First one is that we've seen an increase in terms of sentiment. People have been relieved that Labor didn't get elected, and these changes around negative gearing and capital gains taxes have not been implemented. So that was the initial sort of boost in the market. And now we've obviously seen, independent of the election results, you are correct. The government and policymakers are panicking. So obviously we've seen a whole host of policy measures being rolled out to keep the debt bubble intact and to keep the property market buoyant, from the interest rate cuts to the APRA changes in terms of the minimum floor rate for lending that the banks have to impose when they assess a bank customer coming in for a mortgage, to obviously the 5% first buyers policy, which should come out in 1 January 2020, from aggressive migration policy that's still intact. There's the policy that the government is now pursuing around what they call tiny homes. Basically, they want Australians to live like hermits in these very, very small homes. And obviously, they're trying to stimulate the construction sector in terms of potential work and provide affordable housing. But these are very unpractical measures. But obviously, Parliament has passed the income tax package, which the government took to the election. So with all of these policy measures, it will take time for several of these measures which have already been implemented to play out. So I'm looking largely at the spring selling season for property, particularly in the eastern seaboard. So September should give us a bit of a indicator as to whether these measures have worked or not. Obviously noting that the 5% first home buyers program won't come in until 2020. But obviously, if we start to see result not going the way that the policymakers would hope, that's potentially where we may see even more aggressive and even unconventional monetary policy starting to be rolled out. And this is where I've voiced many concerns on this program, but also with Martin North around zero interest rates, negative interest rates, quantitative easing, helicopter money, modern monetary theory. All of these techniques are effectively ways of debt monetization, which always leads to runaway inflation and debasement of fiat currencies. So that's the direction in which policymakers have both publicly and privately indicated that Australia will go. And there was a show that I recently did with Martin North where we talked about a private meeting between the Reserve Bank and the commercial banks, and they talked about unconventional policy, and they said that negative interest rates for Australia are definitely on the table, and so that hasn't been publicly admitted to yet, but obviously we still have an indication that rates may come down even further. Westpac is expecting rates to hit 0.75% by the end of the year, and AMP and I think JP Morgan are expecting that the cash rate will hit about 0.5% in mid-2020. So what I would say is, we still have a bit of time to see what happens with the property market. Obviously, when you're getting these very bullish forecasts from BIS, Oxford Economics, that Brisbane house prices will go up 20% in 3 years, and Sydney and Melbourne will go up by 6%. And the only way that happens is households, either existing or new households, have to take on more debt. And one of the I think questions that that policymakers don't have an answer to, and we'll have to see how this plays, is, well, for those households that are basically up to their eyeballs in debt, how much more debt can they take on that would allow property prices to go up? So there's obviously a big policy question there, but I think at this stage it is a wait and see in terms of whether they can stabilise prices, whether prices will come back up, or whether these initiatives fail. And if they do fail, I expect to see more aggressive money printing in late 2019, early 2020.
John, there's only 100 cents in a dollar. That's all there is. That's all there's ever been. And I look at it now and I think to myself, okay, real wages aren't increasing at anywhere near the rate of the property values. That won't change. Real wages aren't going to accelerate from here as much as the government would like that to be the case. So the whole exercise is unsustainable. I mean, it's kicking the can further down the road. We'd all agree with that. But it can't work, John. I mean, at school I wasn't the best at maths, but this isn't really all that hard to work out. So if you drop interest rates another 0.5%, how much difference is that going to make? And that's about all they've got left. So if your wages can't keep the pace with the cost of the value of properties increasing, how on earth do you sustain this? It's just, please, if there is a way, explain it to me.
So, look, I think you make a very good point. I mean, I don't think it is sustainable, and that's why I've been, very aggressive in saying that Armageddon is coming to Australia, even though that some of my critics continue to criticise me publicly. And one of the well-known critics of mine was out in his newsletter last week, taking some shots at me. So, but no, the thing is that the whole situation is completely unsustainable. I mean, you are correct that wages can't keep up with the cost of living and with these increases in debt. It's interesting that so last week the Reserve Bank released a research paper in which they said that as households increase owner-occupier mortgage debt, consumption goes down. So that research finding is something I actually wrote in a column in 2016, because basically over the last 30 years, you've seen when unemployment goes down, the average level of economic growth, that continues to slow down. So over the last 30 years, every time unemployment's decreased, economic growth has been lower on average. And one of the things I pointed to for that phenomenon is because of we have more debt, and obviously if you have more debt, you have households that have less capacity to spend and to borrow, and that obviously means that you've got slower growth because there's a mathematical limit as to how much debt households can take on. And so that was something I wrote for the Spectator Australia in 2016, and lo and behold, last week the Reserve Bank basically came up with their own independent study that made that same point. Now, it's very important, this research paper, because the standard economic orthodoxy has been that basically debt levels should not really impact on consumption. So basically, going back to Milton Friedman with this permanent income hypothesis, the view was that, for example, if you doubled your debts, if you doubled your assets and you doubled your debt, you doubled your debts, and net household wealth remained constant, well, that should not have an impact on consumption. And the research that was released by the Reserve Bank last week showed that basic premise was wrong. Basically, as people get more into debt, people get nervous about the debt, and then they spend less. And so, because we have a record amount of household debt, I mean GDP, our national sort of economic income per year, 65 to 70% of that is consumption. And so, because we have high levels of debt, that means people are spending less, particularly when it comes to retail, and that means we're going to have lower economic growth going forward. And obviously, one of the big questions for policymakers is where are they going to find new sources of economic growth that's going to keep the debt bubble growing sustainably. I'll be in Parliament next week speaking to several members of Parliament, and that'll be one of the questions I'll be putting to the MPs and senators, to say that I think that the government has largely tapped all of the potential sources of economic growth, and we're going to see stagnating levels of growth going forward with potentially higher levels of prices and inflation, and that's obviously a very toxic recipe for the middle class in Australia.
Well, you actually saw the impact of debt on a visit just recently to Mandurah in Western Australia, just outside of Perth, of course. And I believe, like in conversation with you, John, you're astounded and quite dismayed by the level of poverty, homelessness and crime taking place in an area that was once very settled, sedate, and very much envied suburb. Can you share with us your experience while you were over there in Mandurah, what you actually saw?
About 2 weeks ago, I went for about 5 days to Western Australia. So I spent a good chunk in Perth, and we did spend half a day in Mandurah. So Mandurah is about an hour south of Perth. So basically, during the mining boom, a lot of people bought. So there is a lot of retirees down in the area, but a lot of people bought holiday homes. And obviously, the property down there still looks in fairly good shape. But since the mining boom has sort of gone backwards and it has dissipated, Mandurah, the Perth market, real estate market, has fallen about 20% in terms of nominal prices, but Mandurah has been harder hit. So property prices have fallen about 30% in nominal terms. In real terms, about 40%. Rents have fallen about 30%, and basically you've got a very big problem with in terms of unemployment, in terms of small business activity, and the poor economy and the high debt levels has led to a whole host of social problems. So you look at Martin North's from Digital Finance Analytics, his data set. His data is saying that the highest level of mortgage stress in Western Australia is Mandurah. The highest level of negative equity is Mandurah. And the day before I went to Mandurah, I was at the state parliament meeting, a particular politician, And that politician basically said that Mandurah is ground zero for negative equity in Western Australia. So a lot of people struggling financially in that area, and that's obviously led to a series of social problems from so kind of like you said. I mean, there is a very big drug problem happening in Western Australia, Perth, but also Mandurah. And there was, after we did a recent show with Martin North, a couple of things happened. There was the Mandurah Coastal Times wrote an article about our video, about our show. There was a small business owner in Mandurah who went on 6PR in Perth radio and basically cited our show and gave some on the ground evidence of drug problems, about crime problems, about youth unemployment, and this is one of the things that I've continued to warn about publicly, and this is one of the things that's been driving around this economic Armageddon thesis, which is to say that once you get economic policy wrong, it comes with a very big social cost, and there's a whole host of either Irish immigrants to Australia or people like Eddie Hobbs, the Irish financial expert who I've spoken to, who, these people have seen horrific social costs in Ireland when the housing market collapsed. And, we're starting to see some beginning signs of that in Western Australia. And, one of the key reasons why I went to Perth and Mandurah was to, find out what's going on, see it with my own eyes, and to, make a couple of shows particularly with Martin, so that we can tell, particularly on the East Coast, where there are massive debt bubbles, that what's happening in Western Australia is a forerunner to what is likely to come right across the country, and it's obviously not a pretty sight. And one of the first things we saw when we hit the town was enormous, a large volume of for sale signs, for lease signs, for rent signs in a lot of the suburban streets. And subsequent to us being in Mandurah, I got an email a couple of days ago where they suggested that there are quite a few properties in Mandurah where they are listed for sale online, but for whatever reason they have not put a sign in front of their house. So even though we saw a higher level of for sale signs and for rent signs in Mandurah, there's probably a lot more property on the market than meets the eye. And I'm actually speaking to a few local people about chasing that particular angle down.
Yeah, John, look, it's not just happening in Mandurah. I walked out of the office the other day with Jared, and I couldn't help but notice a young lady bedding down for the night. This is in the CBD in Adelaide, just bedding down for the night. She had a rug and a pillow. This was around 5:30, starting to get dark, freezing cold, and that was going to be her place for the night. I'm seeing more and more of this in Adelaide, which is an experience we never had a few years ago, but it's becoming far more prevalent as we speak. So I expect to see a number of Mandurahs start to appear, and this will become more of the norm if the economy continues on as it is. Brian.
Darryl, what I was just going to say on that point is that we're getting, I think, to the pointy end of how this debt bubble is starting to really impact people adversely. And so, I know that obviously you and Brian have spoken a lot about the need to prepare people in terms of their financial position. So obviously it's not just about buying gold and silver, it's also about making sure you don't get into too much debt, and to put money away for a rainy day, and to be prudent. And obviously this is one thing I've been preaching, particularly when I wrote an article for news.com last year about 10 steps of how to prepare for economic Armageddon. So the reality is that particularly in places like like you said, Adelaide and Western Australia, for those who haven't prepared, they're really starting to see some of the horrific consequences of what happens when you've got a bad economy and you're ill prepared for that bad economy. And so, for the viewers who still have capacity and still have time to prepare, all I can say is that while you've got an extra day to prepare, don't let that day go by, and do all you can to insulate yourself and your family from a bad economy. And even though that people in Perth think that the economy is bad, I said to them, Armageddon hasn't started. Even though their property prices has fallen 20% in Perth, the national debt bubble continues to grow. The global debt bubble continues to grow, and the full consequences of that problem hasn't hit the world yet, hasn't hit Australia yet. So Perth and Mandurah will be in far worse shape than what they are now. But even with what they are suffering at the moment, a lot of people have gone through a very rough patch.
Yes. Yeah, and there is time. Well, hopefully there is time. I come across people who say, Darryl, I've been investing in precious metals for 12 months and silver hasn't done a lot. And so did I make the right choice? And I say, well, how much do you have? This is the time to buy it, unquestionably. Gold is starting to go for rip now. We all know that. Of course, it's had a wonderful 9 months. Silver, lagging a little bit, but this is a wonderful time to buy it because that 92 to 1 ratio isn't going to hold for much longer. So I keep on saying, do you have enough? In the majority of cases, people don't have enough to protect their wealth. This is their opportunity, but I don't believe the window is going to be open for a lot longer. Yeah, Brian?
Absolutely. Yeah, John, the 3 points that, I will be covering in this interview will be, one will be, we'll start with the Deutsche Bank, but then we'll flow on to currency inflation and, of course, the price of gold. But let's start with the Deutsche Bank. A lot of news in the last 3 months with the Deutsche Bank. As we all know, it's a German bank, where I think second largest bank in Germany. But recently, as the news report stated, that they're putting off 20% of their employees worldwide. I even heard that the Australian division was going to be leaving the country. But what's your impression? Is there a black swan coming up here? The Deutsche Bank have a lot of derivatives out there. What's your thoughts?
So it's interesting, Brian, you mentioned in terms of black swan. Black swans only happen if you're not looking close enough. So just for viewers who don't understand what the term means is, this term black swan came up in the GFC. Basically, something hits, comes out of the blue, yep, and no one expected it, and people are surprised and were ill prepared for, say, Lehman Brothers going under. Well, Deutsche Bank shouldn't be a black swan. Now, according to the IMF, Deutsche Bank is the 4th largest bank in the world. It is, according to the IMF, this is not me saying it, it is the most dangerous bank in the world. Why? Because it has a massive amount of risky derivatives, about 49 trillion US dollars in terms of derivatives, or 43 trillion euros. A lot of these derivatives are completely unsustainable, and obviously the bank the share price has fallen from 112 euros per share in 2007 to now so it's below 7 euros a share. So the bank has been in a long-term decline. It's been being propped up by the German government and by the European Central Bank. Why they're propping it up? Because, beyond those, the US Federal Reserve, particularly in the wake of the GFC, that they gave emergency lines of liquidity and credit to Deutsche Bank to keep it afloat. Why are they doing it? Because if Deutsche Bank goes, the world goes. That's how risky the situation is. So before we get into a couple of the technical aspects of Deutsche Bank, one of the things that I have viewers and Australians across the country asking on a regular basis, and just to go back to the point that Darryl raised before, is how much time do we have? Well, the reality is that if today is Wednesday, so if tonight Deutsche Bank, if the European markets open up and Deutsche Bank says we are insolvent, the international financial markets and the credit markets will collapse within 1 or 2 days. That's how risky Deutsche Bank is and how systemically important it is to the financial system. So now, you never know when a bank is going to declare insolvency. And just to give an example, so recently in the last fortnight, there was a bank in China that basically said they were insolvent. It's Bosheng Bank. Now, just before this interview, I went. I'm here in Sydney today. I went and met a China, a China expert, so someone who works for an investment bank that's focused on China. And I asked this individual, "Did you see the bank collapse happen before it happened?" And she goes, we completely were surprised by it. So here you have people who spend their professional time looking at China, and they completely missed that one of their private banks went insolvent. And so you never know when, because banks will never reveal their full financial position until they have to. And so we never know. So, I mean, Deutsche Bank's unsustainable. We never know. We don't know when that the point or the day of reckoning for Deutsche Bank will come. But when it does come, it is so significant that it can basically bring down the world economy very, very quickly. So obviously, I mean, that's where I think Australians who I speak to, and you've got those who are asleep, and you've got those who are watching shows like this, and me and Martin who are awake. But even those who are awake, I don't think fully appreciate how risky and dicey the situation is if Deutsche Bank said that they were gone. If they declared that they were insolvent. So obviously, if you look at the second quarter for 2019, Deutsche Bank announced another loss, 2.8 billion euros. And so the losses in the second quarter has spurred Deutsche Bank to take some dramatic action. So just like you said, Brian, they've announced that they're cutting 18,000 workers worldwide, bringing their global workforce to 72,000 workers. They're getting out of the equities business, surprising to some analysts, because we've got record levels in the share markets. So obviously, look, the equities business it should be quite profitable, but for whatever reason, they can't make money out of it, and so they're exiting that business. In the Financial Times of London in the last few months, they announced that they're going to establish what they call a bad bank, or what they call, or what Deutsche Bank is calling a capital release unit. So basically, they're going to set up a separate entity, capitalize it with about 50 billion euros, basically start to put in some of these risky derivatives. And have this 50 billion euros try to settle some of those derivatives that can't be unwound and are too risky. Now that's going to give them some time, but that's not going to solve the problem. And the reason why is that they just don't have 50 billion worth of derivatives. They've got 43 trillion euros of derivatives, and 50 billion is just a drop in the ocean. So the derivative picture is so significant that I don't think global policymakers have any long-term solution of how they're going to actually resolve it. So, Deutsche Bank's a mess without propping up from central banks and the German government. I think Deutsche Bank would have gone already. They've tried to look for solutions for Deutsche Bank, merging with other banks across Europe, and also looking at merging with Commerzbank in Germany. Those merger attempts have failed. Now they're implementing a set of dramatic measures, from getting out of direct lines of business, slashing the workforce, setting up bad banks. That will help to a degree, but again, the underlying problems with the bank, with these trillions of off-balance sheet derivatives, these emergency measures won't solve it. And Deutsche Bank is one of those triggers that has the capacity to trigger a global depression and to bring Armageddon into full force.
Well, after all of that, look, it seems to me the central banks of the world have to come up with some other way of getting the economy moving, and it's obviously not by printing money and giving it to the Deutsche Bank. I'm going to move on to a subject of currency inflation and also measured against gold. And it always worries me when, I believe it's in Australia, at least in 1985, we had a definition for inflation, and they used to use a basket of goods to see what the price was from one year to the next. But after 1985, I only learnt this about 10 years later, that the food and energy were taken out of the basket. Now, I don't know if you've asked your wife this, but bottom line is, I don't think you can have an economy without food and energy. It's one of the two, sometimes the two biggest costs. I've came across a chart just very recently, and we'll put this up on our screen when we post this video. But what it states is the price differences between 1967, this is in the United States in US dollars, but between 1967 and 2015, so we're only talking a few years back. And I mean, it talks about the median house price back there in 1967 being $22,000 to $300,000 today. It also talks about, by the way, it also talks about what a house price in gold back then to what it is in gold today. Now, as I've mentioned those figures, 22,000 to 296,000, but in gold, if you measured it, it cost 648 ounces and today 270 ounces. So if money was actual gold, if gold was the currency, we would have a deflation or a better price for your home. It goes on to average car. Now, the interesting about cars or motor industry is that Darryl and I do presentations around Australia, and we know for a fact that between 1985 and today, the car's gone from a $11,000 purchase to $40,000 purchase. A big percentage, 235%. But in gold, it's actually been up to 11%, but down to actually zero. In other words, it was 23 ounces of gold back in 1985, and it's 23 ounces of gold today. Which currency would you prefer? Then it starts to look at the last one, a loaf of bread, 22 cents back in 1967, $4 today. Whereas in gold, it was 0.006 cents to 0.004 cents. So again, it's devalued. So what I'm asking here is that how much longer are we going to be using fiat currencies? When are people going to understand? And I'm a great lover of the gold standard, so I suppose I'm a little bit wise to this. But when do you think people will start, or governments really, start to really concentrate on maybe we should have a gold standard to bring the prices down? What are your thoughts?
So, Brian, look, you've raised a few points there. So the first thing I would say is that, so this is something I've written on my personal website, adamseconomics.com. I mean, there is clear statistical evidence that governments and central banks around the world have manipulated traditional inflation measures. So just to pick up on one thing, so the Consumer Price Index published by the Australian Bureau of Statistics. So there's a headline rate and there's an underlying rate of inflation. So food and energy, I mean, that is still technically in the basket, but central banks like to when they focus on inflation targeting as part of monetary policy, they like to focus on what they call core inflation. And core inflation is basically things that are supposedly volatile, like food and energy, and hence that's where some of these in different inflation measures, when they look at core inflation, that excludes food and energy, but the actual official statistics, so food and energy is still in the basket. But obviously in the Australian context, I mean, there's been a massive amount of manipulation with the CPI. In 1998, the price of land was effectively taken out of the CPI. That has had enormous impacts on, like in terms of suppressing the real rate of inflation. So you've had that. You've had statistical manipulation, like introducing things like geometric means, introducing hedonics for technological products, where basically you try to take account of technological improvements, and the effect of that has been to suppress the potential rate of inflation that the CPI would measure. So this is something that I've tried to approach certain politicians in federal parliament and say, the parliament needs to have an inquiry into the CPI to establish what is the real rate of inflation, and obviously we need to move away from these this so-called narrative of low inflation, because the government continue to say we have a strong economy with sound fundamentals, where we have low unemployment and low inflation, and yet the opinion polls continue to say that the Australian people are suffering from cost of living. So if cost of living is the number one economic issue in the country, it's not logically consistent to say that inflation is low. So obviously with all this money printing, by the Reserve Bank, and the massive amounts of credit being released by the banking system and low interest rates, that's had a huge impact on the value of goods and services, the value of housing, and the cost of living, and the people are feeling it. And obviously the government hasn't acknowledged the extent of the inflation problem that Australia has. But obviously, those numbers you reported in the graph in the table, that obviously points to the fact that had whether it's in Australia or in the United States, had you held your wealth in gold or held your money in gold and silver relative to either the Australian dollar or the US dollar, you would today be able to enjoy a higher standard of living because gold has gone up to a greater degree than in terms of the price of an ounce of gold relative to some of these ordinary products like bread or cars or milk or housing, etc.
Absolutely.
So basically, the net effect of that is that you would need less gold today to buy the same products compared to if you're using gold back in 1967. So and so obviously even though I studied a degree in economics, you're not taught in Australian universities the role of gold and silver, how gold and silver over 5,000 years has held its value, whereas fiat currencies for the last at least 1,000 years, going back to China in the 11th century, where these currencies continue to fail. It should be mandatory learning for every economic student in Australia to learn about how fiat currencies fail and why they fail and why why commodities like gold and silver, have been seen to be money for 5,000 years and why they continue to last. So I think you make a very good point. We do have an inflation problem. It's much more significant than what the government says that it is. Gold and silver is a way to maintain purchasing power and to ensure that people have a good standard of living going forward, and they don't lose out because of the money printing. And in terms of how long will the current system last? We'll have to wait and see. I think once the central banks start to get into this unconventional policy of severely negative interest rates and QE and helicopter money, confidence in the fiat currency system, both here and around the world, will continue to wane. And the average guy on the street will start to ask themselves questions as to why the governments around the world are doing this. Is it sustainable? What's the impact going to be on the cost of living? And we're going to see more people waking up. But I think with statistical manipulation, governments have been very effective in suppressing the truth from their own citizens, but that can only last so long. And I think economic reality is soon going to catch up with a lot of Australians.
Mm-hmm. Yeah, you make some wonderful points there and very, very accurate. Now, I'm going to make one more statement here. We will finish off on that statement from me anyway. We'll move over to Darryl. But I think the government has an idea that if they can manipulate the inflation rates, they don't have to rise the pension on a yearly basis. So if they keep the inflation down, right, the pensioner they foot the bill, but they don't get a rise in their pension. So it's just a thought that comes along. Darryl, I'm going to move it over to you.
The US yield curve is inverted again. The yield curve inversion between the 3-month and the 10-year note widened to its deepest level since the GFC. And we know what this means. Historically, it's a barometer of the economy and a very strong indicator that we are heading into a recession. So this is basically confirmation, isn't it? Because it's firmly entrenched in this position at the moment. So what's it telling us, John? I mean, I know you would be able to tell me, I think it's 3 months to 27 months or something, 18 months. Is it 3 months to 18 months? That's the indicator before we have a recession. The mere fact that it's done it again, what's it really telling us?
So, viewers, but also people who came to our recent seminars in Adelaide, Melbourne, and Sydney would have heard me talk about the inversion of the yield curve. So, the US Federal Reserve itself has said that the most accurate predictor of a recession in America is the inversion of the 1 to 10 year yield curve. That inverted in late March of 2019. So obviously we're now seeing, and we've seen this for a while, the inversion of the 3-month or the 90-day rate relative to the 10-year. But according to the last 7 recessions. Once the 1 to 10 year yield curve inverts, that's the most accurate predictor of a US recession. And based off that, based off the last 7 recessions, the window for when the recession starts is anywhere between 3 to 27 months. So if history is any guide, given that the 1 to 10 year inverted in March of 2019, one would expect a recession to commence no later than June of 2021. So and that seems like a long time away, but the first moment in which the yield curve inverted before the global financial crisis was actually December of 2005. So even though the bond market is signaling that interest rates are too high, that there is a lack of confidence in the economy, in the US economy going forward, it still takes time, the inverted yield curve in the bond market, to play through the economy. And so far, it's been about 4 months since the initial inversion of the yield curve. We've seen the yield curve invert in some places more aggressively than in previous months gone by. That's obviously a negative sign for what where the US economy is going. Now, obviously, we've had the Jerome Powell, the chairman of the US Federal Reserve, basically, from December last year, saying that they were going to stop the rate rises, they were going to put a limit on quantitative tightening. Now we've seen, congressional testimony last week indicating that that at least at the next, FOMC meeting, that interest rates were going to be cut. Obviously, QT, sorry, that it has now basically come to an end. And we're going to start to see, and obviously Donald Trump himself has called for quantitative easing to be able to recommence. And in the last 24 to 48 hours, there's been an announcement by the US Federal Reserve that they're going to launch a new repurchasing agreement in January of next year, because with the 30-year bond yield, you've started to see that go up quite aggressively in the last week of trading because of potential inflation concerns. And so they need to do quantitative easing to keep interest rates, or in terms of the bond yields, low. So it's obviously it's not a good sign that we've got an inverted yield curve. It does indicate that we're headed towards recession. But central banks around the world are basically throwing the kitchen sink, trying to keep the what they call the expansion going, or what I call the bubble. So it's not just obviously we've talking about the Australian Reserve Bank cutting interest rates. The Americas are about to start, and the Europeans are already basically zero interest rates or negative. The ECB will continue. Have said they're going to recommence quantitative easing in the months to come. The Bank of Japan continues to print. The Chinese, particularly with one of their banks falling over in the last month, has continued to print more money and try to suppress interest rates. And so everyone's throwing monetary policy in the same direction, which is they're trying to stop history from repeating itself and stop the recession from coming. And try to keep the show on the road. And there's obviously concern about how effective that's going to be. And obviously, given that we've got extremely low rates at the moment, you're starting to see some economists and some policymakers saying that the effectiveness of monetary policy has come to an end, and now we need to do other things to be able to keep the show on the road. And this is where there's a big appetite for governments to spend more money. Even in the Australian context, they want people to, the Reserve Bank wants a big infrastructure program. They want new spending, and they basically want fiscal policy to take over. And what does that mean? It just means more government spending, more deficits, more debt. And again, long term, in the history of humanity, not sustainable, not good for the average Australian or the average citizen around the world.
Signs are clearly there. We cannot say we haven't been warned. I mean, for anyone today who does their research and watches interviews like this, And there are many of them across YouTube channels around the world. I mean, there's plenty of really good sound information, and somebody gathers that and puts it all together in their head. They're all going to draw the same conclusion, which is about what Brian's going to make reference to now, and that's where gold, or how gold has performed over the last few months. In fact, it's had a glorious 9 months. And we're going to share this because it's such a really good subject, isn't it, Brian?
Absolutely. Yeah. So, before Darryl has his closing remarks, just on the subject of gold, because basically the last 3 months have been absolutely fantastic. Darryl, I agree with Darryl, 8 months. The last 3 months we've seen gold go in Australian dollars, 1,800 right through to $2,010 per ounce for spot pricing. We've also heard Eric Sprott. We've talk about the pricing of gold, and he interviewed a gentleman, Paul Tudor Jones from America, a great investor. And what he was saying is that if it passes 1,400 US, which it has done so now, it will quickly go to 1,500 by sometime in this next 6 months. But soon after that, 1,700 US dollars before in a blink of an eye. So we've seen some great moves in the last 8 months. Looking at 1,700 certainly does not look impossible by January, February of next year. What are your thoughts? Where do you see gold and silver? I mean, it hasn't taken off yet. Are we going to see some fabulous moves in silver? I think we are, because it has been probably the most manipulated precious metal there is out there. And at 93-to-1 ratio, oh boy, there's some skyrockets coming. So what are your thoughts?
So in terms of gold, I mean, obviously, the gold market has seen some aggressive action in the last 12 to 18 months. I think viewers need to consider the gold market from two angles. One is the physical market, and then the other is the paper derivative market. So I think we've said in a previous interview that 2018 saw the largest amount of central bank net purchases of physical gold since 1967. So central banks and high net worth individuals across the world have been buying physical gold in very large quantities. And obviously in recent times, we've seen a lot of action in the paper derivatives market, aggressive buying there in terms of ETFs and hedge funds trying to take more aggressive action on futures contracts. I think that's been supported by some of the announcements around public policy. Particularly, we had a 6-year trading range on gold, where gold couldn't get above about $1,360 an ounce US. And then basically once Jerome Powell confirmed that interest rates were going to be cut in the US, that's where we saw 2 or 3 trading days, and this was happening in the mornings of in terms of Australia, because I was looking at it on my screen, and I was on the phone with a friend of mine and just saying, just look at how vertically aggressive these increases in the gold price was, whether in US dollar terms or in terms of Australian dollar terms. So obviously we've seen gold in Australian dollar terms. I mean, I think you said it went up to 2010. I think it got up to about 2040.
That's right. That reached a peak of 2040.
Yeah, so it got up to there. We've seen that level of that price range hold for the last few weeks. But again, I mean, without getting too much into the manipulation of gold, precious metals through derivative contracts, the underlying economy is weak. The underlying direction of public policy is more money printing, more stimulus, more debasement of the value of official currencies like the Australian dollar and the US dollar, and so I expect that gold and silver prices will continue, a long-term trend, in terms of going up, purely because the governments around the world have said that they plan to continue to print more money and to do it in a more aggressive fashion, and they have to do that because they need to keep the global debt bubble intact. So the bigger the bubble, to obviously to keep it intact, they have to print more and more money in an aggressive fashion, and obviously to keep some of these banks alive. I mean, they have to be aggressive there. I mean, when Deutsche Bank basically went belly up in the last month in China, the People's Bank of China basically printed a whole bunch of new money and then basically nationalized the bank. So again, if the Australian banks got in trouble, if the American banks, if Deutsche Bank got in trouble, the only way you stop a systemic collapse of the banking system is central banks have to print more money and just try to throw liquidity at the problem and try to keep these institutions alive. But in the process, you basically debase your currency, and again, it will have not only an inflation impact, it will have an impact on confidence around the sustainability of policy. People will panic, people will rush into gold and silver, and that's what's happened, throughout history. When people panic, they around economics and the value of currencies and the political system, they do tend to move into gold and silver. Obviously, we've seen some action in the gold market so far. You are correct that the gold-silver ratio is at 93. And I think I said it at my seminars. I have a little bit of gold and I have a lot of silver, and I will continue to buy silver because if the purpose is to buy low, sell high, and silver is ridiculously cheap, particularly especially to gold. The way these markets historically have worked is gold will go first, silver will then follow. Silver will become more aggressive in its price acceleration. The gold to silver ratio will shrink, and your rate of return on silver, historically has been higher relative to gold. Now, some people think that's going to happen again. I'm one of those people. Some people, a little bit skeptical about how aggressive the silver price will be relative to gold. And so there are people who are preferring gold in this market compared to silver. But I think no matter which one you hold, and if you want to hold both, the direction of the central bank policy is should cause people concern about holding official government currency. And gold and silver is the only refuge you've got, and it's been around for 5,000 years, and it's stood the test of time.
Yeah, absolutely. Darryl.
Look, I'm intrigued, John. I've got to say this, that and I repeat myself, I know, but gold is now, it's responded beautifully. It's at its highest price in recorded history in this country. And yet you'd think it would have been worth a mention on mainstream media. You would think that if you turned the television set on tonight and you watch the news and the finance section, which gets about 2 minutes and that's all, but you would think that they'd pass the comment and say, hey, and gold is at its highest price in Australian dollars in all of recorded history. Now, what would happen to gold prices if that happened? I know exactly what would happen. Everyone would want to buy gold the following morning. The only thing at the moment is they don't know that gold is at its highest point in recorded history. Let me share something with you. This is not just Australia, John. This is 75 countries around the world. You probably know all this anyway. But 75 countries around the world at its highest price in recorded history. This is unprecedented. And we're not talking about developing countries. We're talking about countries like Australia. We're talking about countries like Canada, Great Britain. So unprecedented. What people don't understand is this, that gold, this isn't just a phenomenon. Well, it may be a phenomenon right now, but gold has been a good performer. It's been a great performer over the last 17, 18 years. So 2002 through to now, 2019, 17 years, gold has averaged 12% year after year after year. It's been an average of 12% return over 17, 18 years, which is much better than the stock market and compares pretty favourably, one would think, with real estate. So I know that we're talking gold here at the moment, of course, but Jim Sinclair just recently, with Bill Halter, we're talking $18,000 gold. That's where they believe it's going. Based on the US debt and being able to cover that in a reset with gold, reprice the currency in gold, it would be around $18,000 an ounce. But silver, and Jimmy Sinclair says the same thing, silver is like gold on steroids. I mean, 93 to 1, 92, 93 to 1. If it closes into anything like 30 to 1, which historically it's done on a very regular basis, then the return is just going to be, on investment, is going to be phenomenal. Jim Sinclair, once again, and I bring this man to our attention because he constantly says what we all have to do is become our own central bank. Smart central banks, the Eastern banks at the moment, own lots of precious metals. They own lots of gold. It gives them power, it gives them influence, it provides for insurance. And that's really what we all have to do. We've really got to cover our backsides. Gold and silver are the ultimate form of insurance. I could go on for a long time. You appreciate I get pretty passionate about this. But any closing comments from you, John? I just see we're heading into a wonderful period for precious metals, people. Any closing comments, John?
It's interesting you mention the fact that the nightly news in the finance section won't mention that gold has hit a historic high in Australian dollar terms. I had a conversation yesterday with a lady from Melbourne who lived in Romania for her first 25 years of her life. And she lived, under Soviet occupation, and so she's aware of, what's really happening with the Australian economy. And I was asking her, we were talking about propaganda, and I asked her what was life like in Romania under the Soviet occupation, and she said, well, the news was fake. But everyone knew it was fake and everyone ignored it. And the difference between Romania and Australia is that there's still a lot of people who watch the nightly news and believe what they hear, and think they're getting the full story. And so unfortunately, particularly people who have racked up huge levels of debt, because they have been listening to mainstream sources and mainstream messages. These people have been led down the garden path, and so I may say something more about this publicly moving forward. But there's a lot of propaganda. There's a lot of spruikers. There's a lot of people who want to say everything is hunky dory from the Prime Minister down. And I've said this publicly, and I'll say it again. There are people inside the government who don't agree with the Prime Minister, who don't agree with the Treasurer. I speak to these people on a regular basis, and I'll be in Parliament next week having further meetings with these people. People need to ultimately take responsibility for their own economic and financial in terms of their situation. They need to, if they want to listen to us, they can listen to us. But do your own homework, do your own research. Read my stuff if you want it. Listen to Darryl and Brian if you wish. There's a lot of information around the world that supports our position. There are people who disagree with us. People ultimately need to consider all the arguments, all the points of view out there, and make their own decision and be comfortable with whatever they decide. But just to follow blindly like the lost sheep and just hope and pray that everything will turn out, that's not a recipe for success or survival.
No. Very, very wise words, John. Thank you again for your input today, John. It's always fantastic. I mean, you're a remarkably knowledgeable person, and a pleasure gaining your insights into this subject. Really appreciate it. Finally, once again, I'd like a big thank you to our subscribers for supporting us as you do. Until next time, stay well, stay focused, and goodbye for now.